Corporate Finance Core Topic 2, Forecasting Financials and Cash Flows, Learning Objective number 3. We're going to assess growth and evaluate growth and external funds needed. So when we talk about doing a forecasted financial statement, or in other words, pro forma financial statements, there are two very useful sales growth levels that are often considered. And the first one is called internal growth rate. Now the internal growth rate is your ROA, return on asset, net income over total assets, times your plowback ratio, divided by 1 minus the ROA times plowback ratio. Now if we just go to the spreadsheet and go to forecasted internal growth, I have that calculation right here. There's my ROA, net income over total assets. There's my plowback ratio. And if I just do that calculation, I get 6.03% internal growth. And I'll notice what I do here is I plug that 6.03 into sales growth, which then drives short-term asset and liability growth. When I do that, notice what happens. I just about break even on external funds needed. It's not perfect, but really close. So what is this magical 6.03 internal growth rate? It is the level of sales and short-term asset and liability growth consistent with no need for external financing. So it's the internal growth rate is the rate of sales growth without need for any new external financing. Now it's holding the payout ratio constant. So I'm still have a payout of 25% and a plowback of 75%. That's why it's saying no external financing. This is financing from the shareholders, but it's internal to the firm. So that's an interesting number. This company can grow at 6% without having to issue more stock or debt. And often that's a number that's important, especially for really small firms that may be very costly to issue stock or get more debt, or for a firm that's maybe struggling and it would be difficult for them to finance it, or they don't like their current stock price, they don't want to issue you current stock. So they can say, well, what kind of sales growth can we get without need for external financing? The second one we're going to talk about, sales growth rate, is called the sustainable growth rate. And I'll take my ROE times plowback this time, not the ROA. And then I calculated that in the next worksheet. So if I look at sustainable growth, I have a calculation for sustainable growth rate of 11.405%. I also have another calculation. If I take total liabilities over equity in this base case year, it's 0.8. Now I'm going to forecast, again, my sustainable growth rate is 11.405. I'll then plug in that 11.405 here and here. And when I do that, here's what happens. That forecast is going to say, well, let's zero this out first, the change in debt. So if I grow at 11.41%, I'll need $65 in financing. If I finance that using debt, so 65.68, well, got to do a second pass, 3.14. I'm going to add to that, do another one, plus 14 cents, plus a penny. It looks like if I issue $69 of debt, I've plugged the difference. Whoops, looks like I've got a little bit extra there. So we'll just leave it there, $69 of debt. I've got this down to about 0. And look what happened. My debt to equity ratio, or liability to equity ratio, remains at 0.8. So what is the sustainable growth rate? It's the growth rate of sales and also current assets and liabilities, in which there's no without any need for new equity issuance while maintaining the current liability to equity ratio. Actually, sometimes the liability to equity ratio is called the total debt to equity ratio, so it's a little confusing. I like to just call it the liability to equity ratio, but some people say all liabilities, including accounts payable, are debt. I don't like to think of it that way. But I just like to talk about it that way. But here's what's happening with this 11.405. If that is the rate of sales, I don't have to issue any more stock, but I'm no riskier. Notice that my ROE calculation here with the DuPont, my equity multiplier is remaining the same, so I'm not changing leverage. And in this example, I'm able to increase my ROE a little bit without increasing any risk levels. So this is an important number. It's what level of sales growth can we get without having to issue new stock? Because issuing new stock is sometimes very, very costly for firms. So let's talk a little bit about the financial planning process. Since we've done this process, let's say that the objective of a financial plan is not to simply create the financial model. So our goal is not to just create this model. The model is just a tool to help decision makers consider the financial impacts of alternative strategies. So this financial planning process of trying to figure out, well, what level of sales should we target? And what level of assets will we need to get that level of sales? And how are we going to finance that level of assets? You know, these are big issues, you know, handled in the C-suite, and this model, this very simple model, allows us to kind of think about, you know, what level of sales that we should be targeting and whether 20% and issuing debt to do it is appropriate. Or should we go to level of, say, 6% and not need any external financing? Or should we go 11%? So it's really it's a model that kind of helps us think about the future of our company related to asset growth and sales growth. And the alternative to do financial planning is just kind of stumbling into the future. So, you know, this model requires a lot of assumptions, but I'd rather try to make those assumptions and think about it and talk about it with the executive team than just stumbling into the future. Now, in the next section, we're going to talk about how a plan and forecast affects cash flows. Right now, we've only talked about profits. Let's talk about cash flows in the next topic.